Welcome to the Deep Dive. We are taking a complex stack of materials, in this case the analysis of a crucial earnings call, and boiling it all down so you can be instantly well-informed.
Today's focus is EnerSys, ticker ENS. We're looking at their Q2 fiscal year 2026 earnings webcast from November 6th. Now, the market reaction was good, and for good reason. It was a record quarter.
A record quarter, yeah.
But our mission here is a bit more nuanced. We need to really dissect how they did it, what the structural shifts are, and maybe why management is still, a little bit cautious on the full year outlook.
Right, that tension record performance meets this kind of macro caution. That's always where the most interesting stuff is. So let's start with a snapshot. What were the numbers that hit the tape?
Well, the headline results were, frankly, impressive. EnerSys reported record Q2 net sales of $951.3 million.
Okay, and how did that stack up against what people were expecting?
It sailed right past consensus. The street was at about $890 million, so they beat by roughly 7%. That's almost 8% growth year over year.
Strong top line is one thing, but do they turn it into profit? That's what everyone always wants to know.
They absolutely did, at least on the metric that management wants us to focus on. Their adjusted diluted EPS came in at $2.56.
And that blew past the consensus too, I take it.
By a lot. Consensus was $2.36, so that's a huge beat, and it's a 21% jump from last year.
We should pause here, though, because there was a really crucial distinction this quarter, right?
Yeah.
The headline JAP number, the one you see first, actually missed a little bit at $1.80.
Exactly. This is critical for you to understand. When we talk about these big industrial companies, the adjusted or non-JAP figures often paint a clearer picture of the core business.
Because GAAP includes all the one-off stuff.
Right. Restructuring charges, acquisition costs, things like that. Management is telling us to look at the adjusted number because it shows the real underlying strength of the business model.
And speaking of strength, the cash generation was phenomenal. Free cash flow just exploded. It went from basically nothing last year to nearly $200 million this quarter.
It did. The FCF inflection was massive, up to $197.1 million from just $3.2 million last year.
But that's the right question to ask, isn't it? How much of that is real and how much was a one-off? I know there was a tax refund in there.
There was, and that's a fair point. A chunk of that boost came from a significant U.S. federal tax refund. But even if you strip that out, the quality of the cash flow was still incredibly strong. They're clearly converting profits to cash much, much better. It's a fantastic sign for the balance sheet.
Okay, let's dig into the engine room then, the margin story. And when we talk about structural improvements, we have to talk about the IRA, the Section 45X manufacturing credits. How did management separate that government boost from their own improvements?
They were very, very transparent about it. So overall, adjusted gross margin hit 29.1%. But they went out of their way to say, hey, if you exclude those 45X credits, our margin was 24.9%.
Which is pretty much in line with where it was before. So the core business is holding steady.
Holding steady and even improving a bit sequentially. The point is, the transformation thesis here isn't just about subsidies. They're proving they can drive profitability without them.
And the numbers back that up. Adjusted EBITDA was $146 million, a 15.3% margin. That's growing faster than sales. And that validation ties directly to their big internal project, the EnerGize framework, doesn't it?
It is the ultimate validation, yes. EnerGize is their $80 million annual cost-cutting program, and they're executing. They expect to see, $30 to $35 million in net savings just this fiscal year.
And a big part of that is these new centers of excellence, the COEs.
Exactly. 3 of them, 1 for lead acid, 1 for lithium, and 1 for power electronics.
I thought the example they gave about the power electronics COE was one of the most memorable parts of the whole call. It really brought it to life.
It really did. It showed a direct line from strategy to customer value. They said the COE helped cut component validation time from weeks down to just days.
Weeks to days.
Yeah. And because of that speed, they delivered a custom solution for a huge communications customer in a single quarter. Normally, that kind of project could take 18 months. That's not just saving money, that's winning business faster.
It shows they're becoming a solutions provider, not just a battery supplier. Let's look at the segments then, starting with energy systems. That seems to be the clear growth vector.
Oh, absolutely. Energy systems is the growth engine now. Revenue shot up 14% year over year. The driver, data centers.
The AI boom.
It's the AI boom, 100%. Demand from data centers surged 29%, and the profitability was even better. Adjusted operating earnings, or AOE, jumped 38%, pushing that segment's margin up to 7.7%.
Okay, so if energy systems is riding the AI wave, Specialty is definitely riding the defense wave.
Yeah.
What's the story there?
Specialty is seeing a structural re-rating. Revenue is up 16%, and a good chunk of that, about 7%, came from the Bren-Tronics defense acquisition.
And they're moving into some pretty high-tech stuff, right?
Yeah, incredibly high-value stuff. They specifically mention making specialized thermal batteries for advanced applications, and they even name-dropped hypersonics.
Wow, okay.
And the margins show it. AOE nearly doubled year over year, hitting a 9.2% margin. Management basically said they expect that segment to hit double-digit margins very soon.
Which brings us to motive power, the cyclical part of the business that faced some headwinds but is going through its own big change.
Yeah, this is where the macro volatility shows up. Motive power revenue was actually down 2% because of lower volumes. It's the cyclical reality check in an otherwise great quarter.
But the really interesting thing inside that segment is the move to lithium, which they said is a temporary margin pressure point.
Yes, the transition is happening fast. Lithium sales in America's motive power were up 45%. But in the short term, that actually hurts margins a bit.
Why is that?
Because it's still early days for them. They have higher cost pass-throughs from things like tariffs, and they just don't have the scale yet to get full operating leverage. But management expects volumes to start growing again year over year in Q3.
Okay, let's pivot to the investor view. That huge cash flow means they delevered the balance sheet in a big way.
The balance sheet looks incredibly healthy. Net leverage dropped to a very comfortable 1.3 times EBITDA. I mean, that is way below their target range of 2 to 3 times.
And that gives them incredible flexibility. They clearly think the stock is cheap because they were buying it back.
Aggressively. They returned almost $78 million to shareholders. That included buying back 636,000 shares at an average price under $107. That's real management conviction.
And that conviction is amplified by what they still have left in the tank.
Exactly. A massive $960 million repurchase authorization still remaining. When a company has that kind of dry powder, it signals profound confidence that the stock is undervalued.
Okay, let's talk about the outlook. They gave really strong Q3 guidance, but here's that tension again. They kept the pause on the full year outlook. What are they signaling there?
So the Q3 guidance itself was very strong. Net sales between $920 and $960 million, and adjusted EPS between $2.71 and $2.81. But here's the really stunning detail, the thing that validates the whole transformation idea.
Go on.
The midpoint of that Q3 guidance implies a staggering 46% year-over-year growth in the underlying business, even when you exclude the 45X benefits.
Wait, 46% core growth without the subsidies. That's an eye-popping number. So why pause the full year guidance if the story is that good?
They cited a dynamic macro environment, lumpy customer ordering patterns. It's just them being prudent. They don't want to overcommit in case global uncertainty pushes some orders out. But the long-term tailwinds, AI, 5G, defense are all still there.
This all leads us perfectly into our This Is Not Financial Advices segment. Based on this strength, that 46% core growth, what's the trade idea here?
The trade idea is built on a simple premise. The market is still valuing them like an old-school cyclical manufacturer, not the higher margin systems provider they're becoming. The stock just hasn't fully re-rated yet.
So we're looking for a catch-up trade, basically. How do you structure that bullish stance?
We pitch a highly bullish long position in the stock, but the key here is how you hedge it. You can partially finance the trade by selling far out-of-the-money put options.
Okay, so you're collecting a premium by betting the stock won't crash. But why is that a safe bet here?
Because of that colossal $960 million buyback authorization, management is telling you there's a floor. Their willingness to buy back stock at these levels provides a really credible downside buffer for that options trade.
So the thesis is that Q3 results will confirm that 46% core growth, which will act as the catalyst for a re-rating to new 52-week highs. You buy the upside, and you use the company's own cash to sell the fear. It's a pretty compelling structure.
The catalyst is clear, and the financial floor is very real.
So to recap, EnerSys delivered a record Q2. It was driven by excellent execution, structural cost savings from their EnerGize program, and just clear accelerating demand from places like data centers and defense.
And that inflection in free cash flow, plus that huge buyback commitment, it signals that management is betting big on their own transformation.
So here is the final thought we'll leave you with. Considering those structural margin gains and that deep capacity for capital returns, how much of that $960 million remaining repurchase authorization will management actually deploy before their next investor day in June 2026? And more importantly, what valuation multiple will that capital deployment ultimately drive the stock toward? Think about that conviction.